Stock market operations, fourth chapter for first semester. So the fourth chapter deals with stock market indices. Okay, so indices is nothing but the index. So what is this index? So stock market index, we also call it as stock index. Okay, so it is a statistical measure that reflects changes taking place in the market. So it created by a grouping of few similar stocks among the securities listing on the stock exchange, and the selection criteria would be the size of the company, its market capitalization, or a type of industry, and this criteria we are going to deal at the end. Okay, so change in price of underlying assets will make an impact over the value of the assets or overall value of the assets. Okay, so if price rises, the index will also rise, and if they go down, the index will also. Okay, so the index will also go down. Okay, so now the question is, so why do we need this index or indices? So stock market indices are required to know the mood and sentimentals prevailing in the market. As a human being, so we have mood and mentalities, and it changes, right? So will be not stable in our mind for all the times. Okay, so we feel happy, we feel sad. So likewise, the market mood and sentiments will also change. Okay, so in this changes, so as an investor you can identify the market's pattern by looking at this index, so and use it to decide which stock can prove to be winning bet. Okay, so indices also act as a barometer, the measuring instrument for the peer comparison. So if any stock has given the higher returns than the index, it's said to be or said to have the outperformed. Okay, so it's called as outperformed or outstanding. So on the other hand, if it is or if it has given the lower return, so then we can call it as underperformed. So stock index also aid or help you to identify the trend of particular sector to take investment decision accordingly. So they also help you to make a passive investment, so that is, so investing in portfolio securities, so that closely reassembles the index. So with a passive investment you can cut down on the cost and research and selection process of equities. So there are some indexes or indices in Indian stock market. So some of the common types of index in Indian stock market are as follows. So first is your benchmark indices like Bombay Stock Exchange Sensex and National Stock Exchange Nifty. Okay, so broad or board based indices like your Nifty 50 and BSE 100. So market capitalization based indices such as BSE mid cap and BSE small cap. So sectoral indexes, we have another sectoral indices, so such as CNX IT, so Nifty FMCG, so Nifty Bank Index, so S&P, BSE oil and gas, and so on. Okay, so the next, what is this Sensex, right? So in the stock market parlance, okay, so the Sensex is a pretty common term. So that, or so what is this exactly? So the term Sensex is a brainchild of by the stock market expert, so the person called Deepak Mohin. Okay, so a blend of two terms, one is sensitive and the one is index. So Sensex constitutes 30 of the largest and the most actively traded stocks on the Bombay Stock Exchange. So these stocks belongs to some of the biggest companies in India, so representing the various sectors of the economy. So BSE Sensex was first published on the 1st January 1986 and is often regarded as the plus of stock market in India. So now, how we have to calculate this. So how is Sensex calculated? Okay, so the calculation of Sensex is done by the free flow method. So this method takes into account the proposition of shares so that can be readily traded. Okay, so this method, so what is this free flow or free float method? So this you are going to understand while dealing with the methods of indexes. Okay, so next is we can say the market capitalizations of all these 30 companies whose stocks are traded in is calculated. So post which the BSE or the Bombay Stock Exchange determines a free float factor. So it helps in determining the free float market capitalization, and then the ratio of the proportion are used on the base of or on the base index of 100 to arrive at the value of Sensex. Okay, so the formula to calculate is as follows. So you can go through that. So Sensex is equal to, so total free float market capitalization, so which will be divided by the base market capitalization, so into the base index value. Okay, so then next is Nifty, so which relates to your national stock exchange, right? So Nifty is another widely used term in the stock market. So what is this Nifty? So Nifty is the index of your national stock exchange. So another popular stock exchange in India, right? The National Stock Exchange. So it is a collection of 50 stocks. Okay, so and it's also called as Nifty 50. So it's managed by the Indian Index Service and the Production or Products Limited. So how is this Nifty calculated? So now that you know what is Nifty, so let's see how its value is been calculated. So just like your Sensex, the value of Nifty is calculated through your free float market capitalization weighted method. Okay, so the formula for calculation of Nifty is as follows. So Nifty is equal to current market value divided by base market capital into the base index value. Okay, then next, there are some methods of calculating the stock market indexes. Okay, so full market capitalization method. So in this method, the to determine the scrip, so weight or scrips weighted in the index, the number of shares outstanding is multiplied by the market price of company shares. So the shares with the highest market capitalization would have the higher weighted index or higher weighted in the index and would be most influential in the index. Okay, so the number of shares outstanding means the total number of shares currently held by all its shareholders, including shares held by the institutional investors and the restricted shares owned by the company's officials and the insiders. Okay, so the full market capitalization is nothing but it is equal to the number of shares outstanding into market price of one share. So the second method is free float market capitalization method. Okay, so this free float market capitalization method, so free float is a percentage of the shares so available in the market for trading. So it excludes restricted shares held by the government in the form of strategic investment. So shares held by companies, officers and insiders, etc. So company in the index are provided with a free float factor based on its percentage. So percentage of what? Percentage of shares in free float. So free float, so this ranges between 0.05 to 1.0 value of index through this method is calculated using the following steps. Okay, the first step is free float market capitalization using the formula is equal to, so total number of free float shares into market price of each shares into factor of your free float. Okay. The next, the second step is, so add a market capitalization of all the companies in the index calculated through first step. Okay, so you have to add first step plus the market capitalization of all the companies in the index. Okay, so then the third step is calculate the index value with the help of following formula. So we are going to calculate. So you are going to calculate it as index value is equal to, so the current free float market capitalization of index into the divided by the base free float market capitalization of index. So that into base index value, and this free float market capitalization, so it is used both by your Bombay Stock Exchange plus your National Stock Exchange. Then the third method is your modified capitalization weighted. So this method seeks to reduce the effect of largest stock in the index, so which would otherwise dominate the value of index. So this method sets the limit on percentage weight of the largest stock in the group of stocks. Okay, the fourth method is your price weighted index. So in price weighted index calculation method, each stock influences the index in the proportion to its price per share. The value of index is calculated by adding the prices of each stock in the index and dividing them by the total number of stocks. So stock with the highest or the higher price is given more weight, which has a great influence on the performance of the index. Okay, then the last is your equal weighing. So equal weighing is nothing but the percentage. In this method, the percentage weight of every stock in the index is equal. So all stocks have equal influence on the index value. So the last topic for the day is Sensex Scripts selection criteria. The scrip is nothing but it is a certificate, so which shows that an investor owns a part of shares or stocks. So the general guidelines for selection of the constitutes of your Sensex are as follows. Okay, first, listing history. The scrip should have a listing history of at least 3 months at Bombay Stock Exchange. So minimum requirements of 3 months is reduced to 1 month. So if full market capitalization or of a newly listed company rank among top 10 in the list of Bombay Stock Exchange universe. So in case a company is listed on the account of merger, demerge, amalgamation, minimum listing history would be not required. Okay. The next, trading frequency. So the scrip should have been traded on one and every trading day in the last 3 months. So exceptions can be made for extreme reasons like scrip suspension, etc. So the next is final rank. The scrip should figure in the top 100 companies listed by the final rank. The final rank is arrived at by assigning 75% weightage to the rank on the basis of 3-month average full market capitalization and 25% weightage to the liquidity rank based on 3-month average daily turnover and the 3-month average impact cost. Okay, so the next is your market capitalization weightage. So the weightage of each scrip in Sensex based on 3-month average free float market capitalization. So that should be at least 0.5% of the index. The next is your industry or sector representation. So scrip selection would generally take into account the balance or a balanced representation of the listed companies in the universe of Bombay Stock Exchange. Okay, the next, track record. So in the opinion of index committee, the company should have a acceptable track records. Okay, thank you.